The following presentation was made possible by the Alltech Media Group, a Southern California multimedia company providing exponential branding and marketing services to all their clients. The Alltech Media Group understands the value of the 3W strategy, providing their clients proven, trackable results. Let us make it easy for you to grow your business. Visit alltechmedia.com.
Hello and welcome to this edition of EB-5 Investment Report. I'm Amy Rios. Today we are joined by Matt Gordon, Managing Director of E3 Investment Group and creator of the Scalable Direct EB-5 business model, a unique hybrid of Direct EB-5 that they call the non-regional center. Today, Matt will explain what the Scalable Direct EB-5 business model is, how it differs from other models, and what the benefits are for investors. Welcome to the show, Matt. Thanks so much for being here.
Thank you, Amy. Thank you for having me.
First off, Matt, can you give us a little background of how you got involved with EB-5?
Sure. It's actually a little bit random, like I think most people.
The following presentation was made possible by the Alltech Media Group, a Southern California multimedia company providing exponential branding and marketing services to all their clients. The Alltech Media Group understands the value of the 3W strategy, providing their clients proven, trackable results. Let us make it easy for you to grow your business. Visit alltechmedia.com.
So about a year ago, we were in an investment banking firm focusing on the needs of families in emerging markets and their corporations. And on occasion, they would ask us about EB-5 and how they could potentially immigrate using the government program. And at the time, we didn't know much about it, but it put us on a path to learn. And like so many before us, we were attracted because of the relative low cost of capital. But at the same time, we didn't understand regional centers. We weren't real estate professionals. Myself and my partner had focused on operating companies throughout our careers. So we said, is there some other alternatives? And people said, you can't do it. People have to actively manage it if they're not in a regional center, and all sorts of other problems. But using my legal background, I started to investigate what the actual regulations said and found there were, in fact, legislative pathways to allow people to create structures which were on the direct side of the EB-5 program, or vehicles that directly created the jobs without the regional center, but also did not require the investor to be the day-to-day manager. And that, in a sense, became the non-regional center, which we sort of say jokingly so people understand we're not part of that. But it also became what we call scalable direct, because it's a direct EB-5 investment, but each individual investor is in their own separate legal entity. And what we do is we coordinate and co-manage them, so that way we essentially scale them as if they're one large enterprise. And that gives them all the benefits of scale, like a regional center, like a large company. And it gives them the additional benefit of not being pooled in a larger entity, so that way there's no allocation of labor problems, and if things go wrong, they actually own their own individual legal entity and can deal with it on that level. So we saw all of the benefits of a regional center structure, save the indirect and induced labor calculation, which requires us to focus on operating companies that have high labor creation components. But once we got over that hurdle, we were sort of off to the races in being able to structure these.
So how do you count jobs?
One at a time. We actually count them directly. The entity that the investor capitalizes, and it's an equity investment directly, that is the employer. And since we cannot use an econometric study, there's no indirect or induced, the number of W-2 employees on the payroll or account, they of course have to be either U.S. citizens or permanent residents. Thankfully, through the E-Verify system that's coming through, it's much more certain as to who qualifies and who doesn't earlier in the process. But at the end of the day, at the 829 stage, the I-829, where the removal of the removal of the immigration condition is adjudicated by USCIS, at that stage, they simply just count I-9s and W-2s. So there's absolute certainty.
Now, can you further explain, like give a specific kind of example of your model and how it works?
Sure. So we didn't just design this to be generic. It really came about even before Scalable Direct, where we said, let's focus on industries that we know and really design them so that they fit well within the EB-5 program, as opposed to trying to force them into the EB-5 program. So we actually investigated a lot of different industries, and we were looking for criteria where they were very capital intensive, because EB-5 capital is relatively inexpensive compared to private markets, and also were very labor intensive, because we needed to get over that 10 jobs per $500,000 or $1 million investment threshold. So by doing that, we quickly arrived at the trucking industry. And there was a little of an accident in that. Not really accident, it was a little opportunistic, in that I had actually spent time doing logistics investment banking, so I understood the transportation sector from a finance perspective. And one of my key employees actually spent several years running trucking companies as an operating officer. So I like to say I know it at 60,000 feet and he knows it at 6 millimeters. And together we could see how EB-5 worked so well with trucking, where the way we would set up a trucking company, in or outside of the program, would be the same. So we're not making any compromises.
So why didn't you go the route of forming a regional center?
We looked at it, and we were finding that most people were spending years and hundreds of thousands of dollars. We had neither the time nor desire to spend the money. When we thought operationally it didn't need it, without having the investors pooled in a single regional center, it was better for them. And to the actual operating company, it was agnostic. So we figured we would blaze a new path a little bit and really return to the original roots of the program before the regional centers, and just do it on the direct side.
Now, you mentioned the trucking industry. What other industries does your Scalable Direct model fit? Is it just a certain industry? I mean, with regional centers, you see a lot of projects like hotels and casinos and assisted living facilities. Would those work with your model?
Scalable Direct, again, it works best for industries that have high labor components to it. So a lot of real estate projects don't have the direct labor creation characteristics, which is why they have to use the indirect and induced labor afforded to them under the regional center program. We have evaluated a number of different industries. In the right context, the franchising industry, especially food service, can work. It depends, because remember, you have to have 10 jobs, which consist of 35 hours per week per worker. So not every franchise fits that bill, but some do. And where they do, it can work quite nicely, because the capitalization requirements are about appropriate. Again, you need about 500,000 if you're setting it up in the targeted employment area, or $1 million if not. A key thing with EB-5, though, is if you really want to think about it the right way, you have to think about three what I call constituencies. One is the operating needs of the business. It needs its money, it needs its employees, whatever it is, it is. The second is you have to fit it in with the US government rules and regulations. And the third is you actually have to satisfy the investor demands, because they won't buy it if they don't like it. And currently, investors like the security of physical assets on the company's balance sheet. So that's great for high capital-intensive industries, because there's a real balance sheet there. So if you think about businesses like law firms and investment banks, it's really people, tables, and chairs, a couple of computers. There's no real balance sheet that supports that business that you could say, Mr. and Mrs. Investor, if things don't work out, there's something there for you. Real estate has a great balance sheet. There's physical assets there that make the investor feel secure. Structurally, I don't know if they should feel as secure as they do under a lot of models that are used by regional centers in project development, but in theory, the asset is there. Trucks are a great asset. So it's there. If something goes wrong, it's very easy to sell a fleet of trucks in just a matter of days.
So your clients are the investors?
Absolutely.
Do you work with a team of people? What is your role when it comes to the investors and how you get them? What is your role?
Sure. So we do have a team at E3 Investment Group. As you mentioned in the intro, I'm the managing director. We have staff members, and we're growing from different countries, so we have local language support. We are focusing in the world beyond China. Obviously, everyone knows that China represents 80% of all EB-5 investments. We do have a native Mandarin speaker, but we also have Russian and Korean, and we're probably going to add a Vietnamese speaker shortly, because we're getting a lot of interest from Vietnam. So we're very focused on not only broadening the asset classes available to investors. We didn't get into this to compete with regional centers. We got into it to address the unmet market demand for different product types. Not everyone wants to invest in a hotel, assisted living facility, or what have you. There are some investors who didn't want day-to-day management requirements, who wanted something else, and the market wasn't meeting that demand. That was a very powerful investment thesis for us.
So what is the investor's role? How hands-on is the investor in this?
Really, absolutely none. So there is a legislative pathway, and the legal agreements that I designed are structured to satisfy, which allows the investor to essentially be absolutely passive. It's a bit of a misnomer, because there's the section in 8 CFR, which is the Code of Federal Regulations that governs, says the active management requirement, and then in a sense it allows them to satisfy it by not being active. So it's a little bit of, I mean, we're all having some fun with what's going on in Washington, maybe a little too much fun lately, but it's a little of that legal linguistic silliness that, you know, it says active, but it really doesn't mean active. But it legally works, and ironically, there's been precedent and examples of people using that pathway in the regulations for 24 years. It's just not something that a lot of people know about. There's a big myth out there that if you're a direct EB-5 investor, you must be active manager. It's not the case. There's a myth out there that says you have to live near the investment. If you are not availing yourself of the structures that allow you to be passive, then you do need to live near it, or else how can you be the active manager? But there are other ways to satisfy it as well, including setting it up as a corporation, for example, and being on the board of directors. That under the regulations satisfies. So we do a little of all of it, because it's nice to have a belt and suspenders. So we do require that all of our investors sit on what we call the Policy Formation Board, and twice a year we have a meeting with myself, a member from the trucking company management team, and the investor, and we present them with the results of the company, and listen to their ideas and as a board decide on the future direction and conduct. We actually are big believers in due diligence and transparency. We're probably the most transparent sponsor that's been in the history of the program. Again, hearkening back a little bit to my legal background, because as a lawyer we're trained in due diligence. We're brought up as that being the gold standard of what good investors do. So how can I ask my investors, not make it available to them, to have an equal level of information that I would require if I were the investor? So we give them access to anything that they want, and pretty much as soon as they want it. Even going forward past the investment decision, we'll have an internet portal that allows them real-time financial and job creation information about their investment. So yes, they do get a biannual report which shows them what's going on, but it's actually not needed, because they have real-time access to what's going on in every moment.
Now, are you concerned with working with non-accredited investors?
That's a big topic today. There have always been ways to work with non-accredited investors under the securities rules, and I'm a securities lawyer, so I apologize if I get a little too technical. But under the securities laws, there are exemptions from public registration which allow you to work with non-accredited investors. For example, Rule 506, I'll drop down into detail for a second, says you can raise capital from unlimited accredited and up to 35 unaccredited investors. So technically, we can pick up an unaccredited investor here or there, and that's perfectly fine. I mean, for the usually you'll find that investor in the form of an over 21 child of someone very wealthy, because there's not too many people who are unaccredited but can still afford an EB-5 investment, even in a targeted employment area, is $500,000. By the time they're done with fees and legal and everything, it's getting close to $600,000. You're already 60% of the way there to being accredited. So you don't find them a lot, save for the example of the children of wealthy people who are too old to be covered under their parents' application, so the parents just gift the money to the child so the child can invest the capital directly and receive their green card.
Now, in terms of marketing, and especially in light of the new SEC rules, how do you market this?
We are very mindful of the securities laws. I'm actually licensed by FINRA. I have securities licenses. And so we always follow the rules very, very carefully. So we tend to get a lot of our investor interest through immigration attorneys. So we conduct a lot of legal education where we're just teaching lawyers about new structures they didn't know what was possible. I actually do a lot of writing on securities laws in EB-5 to make sure that the lawyers are familiar with what their clients should and shouldn't be doing. And by virtue of that educational process, a lot of lawyers will then just to simply refer potential investors to us. We also work in a very limited fashion with agents overseas, but we always have to structure them to be in compliance with what's called Regulation S. So we don't interact with the investors while we're in America or they're in America. All of the marketing, 100% of it, must be done overseas. And we have very strict quality control in terms of what materials and what the agents can say or can't say, so we're very mindful to that. The big topic that's on everyone's mind now is, as you referred to, the new Jobs Act rules. Yeah. And I think Jobs Act is great in EB-5 because we're the guys who actually create jobs. So it's aptly named probably more for us than anybody else. There's a trap in the Jobs Act that was unintentional because unlike regular old Rule 506, where you could raise up to 35 unaccredited investors, with the Jobs Act, if you use the general solicitation and advertising, which is the rule I think you were suggesting, where you can then go take out an ad in the Wall Street Journal, take out an ad on an in-flight magazine in business class where international travelers of wealth tend to frequent, you can do all of that now. I mean, you can take out a billboard in downtown Los Angeles.
So why don't you?
Why don't you? Because if you do that, the regulations say that you need to design procedures so that you will reasonably not take unaccredited money. So you lose your less than 35. Now again, those adult children of wealthy people, many of whom are in the United States as students and either don't want a job through their employer because of it changes the power dynamic if the employer is the status sponsor, or they simply don't want or can't get a job. To stay in the country, they need another solution, and EB-5 is a convenient solution. If you use the Jobs Act and you solicit generally, and this is a little free advice, it's not legal advice, a full disclaimer, but if you use that, you can't take money from those kids unless their parents have given them enough money so that they're independently accredited. And that means you're right back up to the $1 million that everyone tries to avoid by putting their businesses in targeted employment areas. So
those kids can't simply become accredited investors simply by having an inheritance?
No, it actually has to be on their personal balance sheet. So the parents would need to gift them sufficient assets so that they have at least $1 million net worth, not including the value of their primary residence. So yeah, it would be an easy one if they just went and bought them a nice luxury condo, but that doesn't work. So it would require essentially an extra $500,000 check.
Now, Matt, can you tell me what kind of protection that you have for investors?
Sure, it's a great question because we really think we shine when it comes to protecting investors' downside risk. As a licensed securities representative with a U.S. broker-dealer, one thing that we do in that capacity is we have to make sure that we analyze an investment so that not only when things go well, but when things don't go well. And so downside risk analysis is a very important part of proper financial analysis. And it's something where I think the EB-5 community has really fallen down on throughout its history. The most existing structures afford investors, I would say, at best, mirage-level downside risk protection. They are in structures where if the real estate deal went bad, it would be questionable if the investors ever got their capital out. And if they could, it would take many, many years. The way we designed Scalable Direct, the investors are isolated in their own little entities. So if something happens, it's very easy to take that entity and separate it from the rest of the group because it really is already separate. It's just co-managed by contract. So all we have to do is void or unmanage it and let the investor take direct day-to-day control. So in our legal agreements, in our partnership agreement with the EB-5 investor, we say, if things aren't going well and we want to liquidate, you have the right to kick us out. We say, you really want your job. Most surveys of EB-5 investors show it's the immigration status which is their most important goal. if we can't create the labor to get you your green card, well, we haven't done our jobs. Now, you paid for this company. You should deserve to fire your management that's not doing its job. So we drew a line in the sand, and we said 9 months before the 829 adjudication, or when it's filed, which is the removal of condition, if we can't certify the creation of 10 EB-5 qualifying jobs, you have the option, not the obligation, but the option, to simply kick us out. So then the investor, at least, some of them get scared by that prospect, but it's power. I tell them, not even half jokingly, well, you have a couple of options. Run it yourself, hire someone to run it, fund it at a loss so those 10 jobs are there when you're filing, so that way you get your green card. Or sit down and say to me, you're going to lose everything if I kick you out, so why don't you reach into your pocket, Mr. E3IG, and put more money into the company if you want to save what it's worth to you. So I teach them how to negotiate with me in case that circumstance happens. I really would never expect too many of them to take over a day-to-day trucking company. They could, mind you. A lot of the more entrepreneurial investors who've been and run small businesses and grown them aren't actually intimidated by the prospect. They consider it a value add, saying, oh, if this guy can't do the job, I'll be okay because I can run this thing. It's just a 10-truck company.
How many investors do you have for this company?
So currently we have filed exactly one 526 application. So it's a pretty meaningful milestone for us. We have a great number of investors who are actively evaluating. We're right now in our 6th month of marketing, so we're a baby in EB-5, and we're proud to celebrate that. We know by traditional milestones, a new sponsor takes 1.5 to 2 years to secure their first investment. Our first investor signed on day 97. So everybody starts somewhere, and we're very proud that we've kind of shot out of the cannon at the trajectory that we have. I've been told by investor number 2's Immigration Council that I should have the subscription agreement by Friday, which is tomorrow. So we're pretty excited about that. And just in the last week, I've had soft green lights from 2 more investors. So we're building a lot of momentum. There's several groups of investors who've come to us and that are all evaluating it. So we're pretty confident that we're going to have a significant number of investors. And again, actually, a key advantage I didn't mention is that right now, most immigration attorneys, and we speak to a significant proportion of the entire EB-5 bar regularly as our job, they report to us that the direct 526 applications are being adjudicated by USCIS in anywhere from as little as 30 days to an average of 4 to 6 months. Now, if you weigh that against what they're publishing program-wide or what people are saying on regional centers directly against 18 months, it's a significant advantage to an investor. We also, again, downside risk protection, we escrow the money prior to the 526 adjudication. Most regional centers are going away from that, and I understand their plight. Who can wait around a year and a half for your money? We can wait 90 days. That's okay. And the way our model works, if the money comes a little faster, we buy 10 extra trucks. A little slower, we wait a month. It's okay. But we want the investor protected, because what happens if you take their money and then the 526 is rejected for whatever reason? What's the investor supposed to do? Now, their money's stuck in the deal. It might take a lot of time, years to come out, but their immigration goals aren't being met. So we thought on almost a moral level, it would be better to use the escrow structures, but protect the investor so that if their proof of funds didn't work, if anything didn't happen, they could at least then move their capital instantly to a different project, because it's already sitting in a U.S. bank. So it's here, it's available for them. So we thought that was the better way to go to protect them even prior to the investment being made.
Now, timeliness is a big benefit to this model. What are some other benefits for investors? You mentioned a couple just now.
Well, sure. I mean, timeliness is better. The fact that it works at the scale of one. It's scalable, but it truly works with a single investor. And fortunately, our investors and the people we've been interacting with, which are some of the world's great entrepreneurs, they've had the confidence to entrust us. So we're having a lot more than one come about. We don't need to wait for the full amount of project, quote unquote, capitalization to be available before we can start, like a lot of project finance opportunities. As soon as the 526 is approved, the money releases from escrow and we put it to work. So there's no delay as to when they start. Because again, you have to create your labor. You have, essentially from when they immigrate into the country, you have approximately 20 to 23 months to file the 829. So the clock is ticking. The sooner you get to work with their capital, the better off they are. So that's a key advantage, that we don't have to wait for other monies to flow in to start working on their behalf.
And some of the kids age out with the time issues, they might age
Well,
out
once they file their application, the children of an investor can age out, but once they file their petition, their age is frozen, so to
Okay.
speak. It's going to become a very significant issue if comprehensive immigration reform isn't passed, as in all likelihood, at least statistically, applications from Chinese-based applicants will be frozen, probably sometime in about 9 months from now.
Do you foresee that really happening?
I do. It probably would have happened this fiscal year. The fiscal year just ended, and now we're in the first quarter of the federal fiscal year. It would have happened if the SEC had not prosecuted, and I'm glad they did, the Chicago developer who had been committing fraud. When that happened, our sources reported a 30% drop in 526 applications, but it was well on the path to hitting the cap, in which case they would have cooled the jets on China. So with the growth rate in EB-5, unless there's either comprehensive immigration reform or Congress takes up a solution for just EB-5, unless there's a legislative fix, I think the good bet is that China's going to slow down a little bit at the end of the year.
Now, the SEC has become more and more involved with EB-5. What are your thoughts on that, and especially the convention center case?
Sure. I mean, and actually just 3 weeks ago there was another prosecution. That is long overdue. But in a way it's also surprising. EB-5 until a couple of years ago was a sub-billion-dollar capital flow program. As I like to call it, it's rounding errors on rounding errors, rounding error. If you think about other markets that the SEC, has to involve itself with, it's infinitesimal. Yet they're paying attention to it. And they only have limited prosecutorial resources. So it's a great program for U.S. policy. As I like to say, and I'm the editor of the current legal treatise on EB-5 called the EB-5 book, published by ILW, I say, this is the modern immigration policy. It's not just you're tired, you're poor, you're hungry, yearning to breathe free. That sits at the base of the Statue of Liberty. The modern corollary to that, and there's still a place for that, is give us your best, your brightest, your wealthiest, willing to rebuild America. Because we need their energy, we need their capital. It's a competitive world. America, throughout its history, has always had a new immigrant class come in and jumpstart things, provide the energy, provide the capital. So EB-5 has a place in the modern growth of America, and that's why you can never bet against it, because it always does attract the best investors, the best entrepreneurs. My goal for EB-5 is not 10 jobs per person, it's 1,000. Because the investors who are talking to us, I was just speaking to an investor who already created one company in America, he has 200 employees. That's a wonderful thing. How many Americans have created companies with 200 employees? So these are the people that are hungry, they have energy, so it's an amazing thing. And these are the people we want to attract here, and we want to make the pathway as easy as possible. So getting back to your question, I'm sorry, I diverted a little bit there. It's great policy. It costs the country nothing. They give out, government gives out hundreds of thousands of visas a year. So it's a little 10,000 visa, and we charge for it, but it doesn't go to the government coffers. It goes to capitalists, it goes to entrepreneurs like myself to create jobs, well-paying, long-term permanent jobs for Americans. That's the type of growth that we need in America, and that's the type of person. Now the problem is nobody paid attention to EB-5 for all but the last 6 months of its 23 to 24-year existence. And I know of regional centers that I won't mention, sponsored by municipalities, that were violating the Securities Act of 1933 because they just didn't know any better. The rules the best practices that are out there are woefully inadequate and don't really acknowledge what the U.S. securities laws are. And if we don't shape up the program ourselves, we the participants, then Congress will either force it down our throats and maybe ruin a great thing, or simply take away what they've given us by legislative fiat. So I've always get out on my soapbox at various venues, and this is a great one, and I thank you for inviting me. I always get out and I say, we have a wonderful thing. We have essentially the least expensive, most patient capital on the planet. And we can do so many wonderful things. The trucking company, for example, could not exist but for the inexpensive capital from EB-5. It's too expensive to go to the private capital markets. And in this case, we can attract the capital and we can create jobs. Our trucking companies are in Center Township in Indianapolis. and it's 17% unemployment. It's the mayor just sent me a letter welcoming me to the community. And thank you. I mean, it's just a really wonderful thing how supportive the community has been everywhere from the governor's office all the way down. But we couldn't do it without the EB-5 program. The numbers don't pencil out. So this is the reason those jobs will be created. And so it's so valuable, and there's so much wealth that can be created for the investors, for the employees, for the sponsors. By all means, why can't we just follow the rules and really make it better for investors, better structures, higher returns? Many sponsors offer their investors 0.5%, 1%. It's structured so that they can't get more than that. That's a little bit offensive. You know, I get it. There's the green card on the table. It's worth a lot. But pay people at least the risk-free rate. Match the government, you know, maturity of how long they're supposed to be in the deal, and give them a couple of dollars on top of it. There's enough money to go around in an EB-5-based project for everyone to get a fair share. So let's make it an example that everyone should be proud of. Are people proud when they say they got the better of their investors because they gave them 0.5%? I don't think that's something we should be proud of. I think we should go out there and say we're currently offering our investors at least 400 basis points above the government risk-free rate. It's a targeted return. We're not allowed to make a promise. That's the way it's structured. But that's our target. And our structure is very deliberate. We don't get what we want until we've done everything we've promised to our investors. We wait at the back of the line.
Yeah, talk to me about the structural risk and what this means for investors.
I'm so glad you used that phrase, because unfortunately I mentioned there was a second prosecution by the SEC just a few weeks ago in Texas, and it was garden variety fraud, a Ponzi scheme, which is really uninteresting and boring. From a legal perspective, it's slightly more interesting because it happened in EB-5, but it was $5 million, which is, you know, of course money, but it's not what you would think of as a Bernie Madoff or some of these other things which involve large amounts of capital. But at the time that they announced the prosecution, USCIS and SEC issued a joint alert to investors. First time ever, which was absolutely amazing to me. And in the joint alert, they actually issued several risk factors that they said investors should look for to see whether there's fraud going on. And I think that was great for them to start suggesting to investors, pay attention, guys. One of the things they asked investors to focus on was structural risk. And until me, I don't think anybody ever uttered the phrase before, and I can't take credit for the SEC paying attention to it. They have smart people there too. But it's a wonderful thing that they're getting people to focus on the details of the structure. I used my legal background in order to come up with innovative and advanced structures for the better of investors. But the investors have to pay attention that projects don't all look the same when you start looking in the inner guts of them. How you set up the structures. Understand, how does your sponsor make money? I can tell my investor exactly how much they're worth to me and when. They're not worth much to me until the end of our relationship, literally probably 4 or 5 years down the line. But that means I have to do everything that I promised to them in order to get the pot of gold at the end of the rainbow. And that means my incentive structure and my relationship with my investor is balanced. Most regional centers or most other projects in general that are where the investor is not the real owner of the business and running it day to day, most of those are not set up in a way where there's this balance. Usually the sponsor will get their capital or get the value of the capital all at the beginning and never needs to pay the investor. By law, we're not allowed to have a mandatory redemption of investors. We can't do it. It's not a negotiable thing. It's in the law. So that means the investors can be technically stuck in the investment forever. What's to prevent it? Well, if a sponsor gets all of the value before they've done anything for their investor, why would they ever redeem them out? They're capitalists. They will act according to their incentive structure. We've said we're capitalists too, so let's put our incentive structure so that we can only get what we want, which is the value at the end. And we have to work hard every day to earn the right to get that value. And when we satisfy the promises we've made to our investors and their goals, then we deserve that value, but not the day before. And it was important to us to have that balance.
Now, you mentioned some red flags when it comes to structural risk that investors need to look for that the CIS had issued a few weeks ago with this case. Do you know what those red flags are? Can you share with our viewers?
I think a lot of it is contextual as to the type of the investment. You have to understand how everybody makes their money, and you'll understand the incentive structures. Understand what happens if things don't work out. Everybody projects the rainbow, and it's great and it looks beautiful. But what happens in a hotel project if, for example, your occupancy forecasts are off by 5%, the wrong way? What happens then? What happens to the direct labor that the econometric model was relying on? Usually once you've built the nice pretty building and revenues are getting squeezed, a good hotel operator will have to cut variable costs. Well, what's variable in a hotel? You can't chop off 3 floors. You can fire 3 maids. So it's the labor that comes first. So that's a little bit dangerous. So you have to understand the sensitivity of the project, not only financially to repay the investor back and to be able to, but also in terms of its labor creation and how that works. Understanding how the rest of the econometric model works so that if the operator might need to violate an assumption that it's made in its model, will that throw the whole model off? So that way they're essentially having to create a brand new econometric study at the IA29 stage. So you have to sort of get into the guts of it to really understand which project is better than others from a pure structural risk standpoint. Then ask the question, what happens if it just is all falling apart? How am I made whole? How do I get my money out? Can I get my money out? A lot of sponsors say, oh, our investors are protected because they're in a loan structure and their entity has a first lien, first right against the assets even before the equity. We don't have our investors loan, they're equity owners, and they're the first equity owner before us. The way we protect them is we've designed the structure so that there's always positive net worth in their entity. So if it's ever liquidated, all the loans are paid back and then there's money left over. And we design it so hopefully there's a good amount of cushion because the assets of the company, the trucks, they don't lose value too quickly. And if they get broken, there's insurance and all of those good things. But when you have these loan models, some of the danger is, be careful, what if there's a mandatory subordination clause in that? So you might be first lien position today, but if the manager, who's the sponsor, needs to bring in new capital, can he put it on top of you? Well, then your lien might be worthless because if the project gets distressed, that new first loan lien will get paid off and you might get nothing.
Well, a lot of these investors may not be sophisticated and be relying on their regional centers to do all their due diligence and transparency.
Well, it's sort of like saying, well, Matt, you tell me whether you should trust me. I mean, you can't have a regional center do due diligence on itself, nor can you have, E3IG do due diligence on itself. I don't even want to pay people. I won't even pay someone to do a due diligence report on me because that's almost a form of advertising. We have had investors hire financial advisors, and there's a couple out there who do focus on EB-5 to evaluate us and issue independent reports. And that gives them further confidence. But it's a little bit tricky in EB-5 because unfortunately they are very complex projects. And with us, at the end of the day, it's a little 10-truck company, so you can sort of get your arms around it. With some of these big project developments, you can have multi-$100-million projects, and you're asking someone to evaluate and analyze it. I mean, you could spend $500,000, not even a joke, just getting a proper evaluation done. So it really makes it very difficult for independent analysis to be brought in. But it's a tough one, but sometimes investors have had them reach out to their accountants, to financially savvy friends. We had one investor walked into my office on Monday with an entire entourage. I mean, they were all friends and relatives of him, but they were sharp cookies. They asked great questions. And they got into the heart of doing these types of analyses. And so I think investors really need to start asking the hard questions. Don't trust the agents because the agents are motivated. Even when they are trying to act honestly, they're of course motivated, they're not disinterested. Trust your own intellect. Ask good questions. Listen to the answers. See if the sponsors will answer your questions. That's about the biggest red flag you can have. I know many regional centers, they're raising capital in droves, they won't answer questions at all. You can't even get information. You want our full financial forecast? We'll give it to you. You want to know everything about us? We'll give it all to you. We have nothing to hide. Be careful of people who don't give you information. That's the danger thing. But in particular, those working through foreign agents, and that's an area the SEC is focusing on very heavily. Because remember, even if you're totally offshore and everything, the SEC never gives up jurisdiction on anti-fraud. And if your agent commits fraud, you could be in trouble too as a sponsor. So it's a tricky area. I'm glad the SEC is focusing on it because it's going to force people who either don't want to or didn't realize they had to clean up, and that'll make a better program for all of us.
Now, where do you see the EB-5 program heading? Do you think that with your model, now others are going to come into this and copy or clone it?
I hope so. It's hard to be a trailblazer. It really is. I mean, it's kind of fun in a sense to kind of invent something and get out there and do it. But if there were other people doing Scalable Direct, I could just point to them and say, you know, don't worry about it. It's a model that's out there. And even though at the end of the day, it's just a simple direct investment in the EB-5 program that's existed for 24 years, anything that people haven't seen before in the way it's being done seems new and scary, and it's really not. But we welcome the competition, partially because we think for operating companies, it will help broaden asset class, which will attract even more people. You'll get more than one plus by having more sponsors into the program, focusing on lots of different areas. We ultimately will come up with hopefully 4 or 5 different investment opportunities. So if people don't like trucks, and some don't, okay, I get that. They'll have a different opportunity to buy into. But we need a lot of people coming up with more innovative structures, better for the investor, more clever, smarter. I'm hoping that I started this path, not ended it.
Thank you so much for joining us today.
Thank you, Amy.
E3 Investment Group's Scalable Direct Model is an innovative, alternative way to serve a group of investors without a regional center. This allows investors to gain more control over their investment without the mingling of funds, and it also expedites the process. We'd like to thank Matt Gordon for joining us today. I'm Amy Rios, and I want to thank you for watching this edition of EB-5 Investment Reports Dialogue Series.
The following presentation was made possible by the Alltech Media Group, a Southern California multimedia company providing exponential branding and marketing services to all their clients. The Alltech Media Group understands the value of the 3W strategy, providing their clients proven, trackable results. Let us make it easy for you to grow your business. Visit alltechmedia.com.